we're approaching the end of stock trading on Wall Street this Monday. Our next guest says the bull market remains healthy. Joining us right now from Richmond, Virginia is Rod Smyth. He's Chief Investment Strategist at Riverfront Investment Group, where he helps manage nearly $2 billion in assets. Rod, great to have you back here on Street Smart. So the rally is still healthy. How come?
Well, I think you want to look at technical levels for what they're telling you about the economy and about where investors' heads are. And what we've been doing really since the lows is resetting to pre-Lehman levels in most markets. That was about 1170 S&P, credit spreads, all of these markets. And that was the stimulus that was put in, the sort of temporary factors got us back there. What's interesting about the market in the last week or so is that we're starting to break through those levels to the upside. And I have felt all year that the only way the market would be able to do that is if it was start to look into 2011 and see a broadening and a continuing of the economic story. And I think that's what's happening in the last week or so.
Does the data, Rod, does the data feel like it's really been getting better, though, in the last couple of releases? I mean, obviously, 162 last week was a little bit under consensus, but a stronger private showing than we expected. And then you've got new pending home sales today coming out, much better than we've seen in so long, in 4 years. And then the services industry growing as well. I mean, surge is really the name of the day when you talk about economic activity. Does it look like it's getting better?
What I see is broadening. It's now starting to be hard to find an area, and there are bits of the housing market, as you might expect, that are still weak or relatively weak. But it's starting to look very broad to me. And the other thing that's going on, which is, I think, counter to what a number of us might have predicted, is that the consumer has stopped raising their savings rate. People are starting to spend a lot more of what they're making. And ultimately, I think the savings rate has to go higher. But that broadening, combined with some employment, says to me that the risk of double dip in 2011 is very low.
Rod, though, how much of this is the result of all that stimulus? You know, some people say that what we're seeing is just kind of artificial because it's based on the unprecedented easing moves that we've seen by our central bank and banks around the world. How much of it is a result of that, and that come next year, as we continue to unwind all of this, that, you know, the rally is stopped short?
Yeah, well, I think that you've got to factor in a backing off of stimulus in the second half and into next year. So you've got to take a point and a half off the growth numbers. The issue really is whether you're going to have 3% type growth or 1.5%, 2%. 1.5%, 2% will feel pretty slow. I think that's not enough to keep, for example, the retail sector going, some of the more domestic consumer cyclical groups going. 3% would, I think, be an upside surprise. Where I stand at the moment, though, is I look at these markets, and the only thing that worries me is, on a more tactical basis, is that sentiment is starting to get back up there. If you're a trader in this kind of cyclical bull market, and I think the cyclical bull is still intact, you want to trade against sentiment. So the only reason that would cause us to take some risk assets off is if sentiment really pushes up into sort of super optimistic territory. But the way we are positioned and what we believe is that it is right to stay with risk assets and to stay underweight things like treasuries. And as I said, my take from the data is that we're seeing a broadening and that there is more than just the stimulus, so that the economy will not go into a double dip when the stimulus fades.
What about I mean, surely there are fundamental headwinds. Other than that, you've got the problems with sovereign debt that still really haven't gone away, right? And you've still got 9.7% unemployment. You've still got a real issue, even Christina Romer points out, with consumers in this country who really haven't deleveraged.
No question. I mean, the structural issues that the U.S. is facing are extremely well known and extremely well documented and extremely serious in the longer run. I don't think there's any doubt about that. But where we're at 1170, 1180 on S&P, all we have to do, in my opinion, to hold these levels and move somewhat higher is continue to march towards $80, $85 worth of earnings. And I think that is what's happening. So when I look at the balance sheet, there's always things to worry about. I think the sovereign debt issue is actually the one that, in a longer term basis, I think we've got to really keep our eye on. But even there, the market is not telling you, either through the dollar or through the level of treasuries, that we're at critical levels. I do think that what's going on in Europe is still a bit of a mess, but the U.S. is still getting financing. And as long as the U.S. gets financing at 4%, 4.5%, I don't think that comes to a head and is too critical.
All right, we got to run. Hey, Rod, good to get some time with you today. Rod Smyth, everybody, Chief Investment Strategist at Riverfront Investment Group.